Hope everyone is doing well. So, a few important things to draw. By the way, I'm testing out something new on the microphone. So, if there's an issue with the sound, please let me know. And let me know if it sounds better or worse compared to the past couple of sessions. So, I thought the most important thing about today was on the daily chart. Here is the September the 1st high, top of the channel. And here's the September the 1st high. We had a sell off, pull back, and a channel down. And we can see we've had a pretty strong rally. And no surprise, the high of the day was 45.97. And you can see the high of September the 1st is 45.97. And as far as the daily chart goes, we're in a trading range. We've tested obvious resistance. We're pulling back. I think we're going to be sideways for quite a while. I think the next target is the moving average. And we can go sideways here and get and drag the moving average up. We can also sell off and test this big bull bar. It was a climactic bar back on November 20th. So overall, I think the odds are we're going to be in a trading range. Probably sideways to down over the next couple of days. First bar of the day, big bear bar. It's a strong enough bar. We're always in long from the gap. We'll probably get at least a small second leg up. Big bar, big risk, following a gap up. And because of the context on the daily chart, I think the upside is probably limited. But the one thing we do know is but we're near resistance and we're so close to 45.97, which is the September the 1st high. So here's the 9-1 high, which is the top of the bear channel. We're so close to it that we will probably have to get up to this price level. Bar 2, it's a bear bar, bad follow through after bar 1. Bar 1's a strong enough bar, second leg up likely, but some of the bulls who bought the close of 1 are going to be disappointed after 2. And I suspect a lot of those traders will look to sell out of longs near the 1 high. And those bulls, they want high probability. If they're buying the close of 1, the last thing they want is bad follow through on 2. So that increases the probability that we get a small second leg up, but there's probably sellers not far above. 3, 2 consecutive bear bars, probably buyers below 2. However, 3 is a bad high 1 buy, so there might be more sellers above 3 scaling in higher. With the magnet just above the September the 1st high, I suspect we're going to go at least a little bit higher. 4, it's a bull bar closing at the high of 3, therefore not as strong as the bulls could be. Plus, it's a bad buy signal bar above 3, but room to the target. And then you can see 5 and 6. 6 actually tested. There we go. You can see 6 tested to the tick the September the 1st high and pulled back. And my thought at this point was it's 2 legs up. It's possible this is an opening reversal, and then we get a bear breakout on 7 and 8 and a test of the moving average. And because of what I've said over here on the daily chart, it's easier to see it on, let's look at a 60-minute chart. Here's a 60-minute chart. And you can see we broke far above a lot of the bars to the left. We broke far above it, climactic bar, and sold off pretty quick. So my thought today had the potential to be an opening reversal. Surprise on 7, probably going at least a little bit lower. We're always in short. We might be. I suspect 7's strong enough for a second leg down. But traders probably want to see one more bar. And then 8, a big follow through bar, consecutive bear bars, probably always in short and going at least a little bit lower. For the bears, they want a measured move from the high of bar 6, open of the day, takes you down here. They also want a test of yesterday's high, which is this blue line right here. And then the next target, open of 7 to the close of 8. So there's a cluster of targets down here. Consecutive bear bars, always in short, probably sell the close for at least a little bit lower. But you need a wide stop. We could easily pull back fairly deep before we get the second leg down. 9, follow through bar, probably going at least a little bit lower, sellers above 9. The bulls, they're hopeful this is a 50% pullback from the rally at bar 81 to the high of 6. And now we have 4 consecutive bear bars, still sell the close, probably going at least a little bit lower, targets below. 11, fifth consecutive bear bar, probably profit taking soon, but I suspect traders scaling in higher. And then 12, bull bar, inside bar. What about buying above it? I would not. It's a micro channel since bar 6, and chances are the best the bulls will get is a minor reversal. 13, low 1 short, probably buyers below. Bears who sold the 11 close, disappointed with 12 in the rally on 13. They'll probably use the first reversal down to buy back shorts. And then let me fix the bar counter here. And then you can see bar 14, it's a bad high 1 buy above the bar. It's a bad entry bar for the low 1 short. Probably going to go sideways. 15, double bottom with 12, but probably sellers above scaling in higher. And then 16, doji, you can call it an inside bar. It's triangle, possible final flag if we break down lower. And then 17, surprise bar, testing the top of the channel. We had a spike, and then we pulled back on 9, and then we sold off to 11. So that's the start of the channel. Probably sellers not far above. 17 is enough of a surprise. We may get a small second leg up. And then 18, bear bar closing on its low. For the bears, it's a double top. You can call it double top with 10, double top with 9, and 18. The bears, they want a downside breakout and a second leg down from the 6 high to the 11 low, pull back, second leg down. 19, high 1 buy after 17, but probably sellers above. You can see the bulls who bought the close of 17 at 81 even. The high of 19 is 81 and a quarter. So a lot of those bulls ended up selling out of longs. 20, bear bar closing on its low. Strong enough surprise, probably going to go at least a little bit lower. Follow through 21, still sell the close and probably going lower. And then a doji 22, so less traders selling the close. Selling into the close, more traders scalping out. You can see on 21, traders did not, on bar 20, traders sold pretty much into the close of the bar. 21, you can see there's a tail below 21. And that's a reminder that something is not quite right with the breakout. It's still probably going to go a little bit lower. And then 22, obviously, a lot of traders bought back shorts as 22 went down. And that's a reminder that this is the downside's probably limited. Doji 23, inside bar, probably buyers below scaling and lower, but first reversal down, first reversal up will probably be minor, which means sellers scaling and higher. 24, bear bar closing on its low, but inside bar on the prior bar lowers the probability of selling below 24, increases the probability of a pullback in the next 1 to 2 bars. 25, another doji, so a lot of overlap. And then 26, there's the pullback. What about buying above 26? I would not. Micro channel since 18, probably sellers above scaling and higher. But the bears may not come in until we get to the moving average. 27, consecutive bull bars, probably buyers below 27 for at least a small second leg up. It's a bad low 1. And then 28, inside bar, still probably buyers below. 29, outside up. But an outside bar is typically a trading range bar. And if you're buying above the outside bar, you're probably buying high in what's likely a trading range. Therefore, this is not ideal. Plus, it's right below the moving average. Better to wait for a strong breakout with follow through before buying. 30, inside bar. Bulls who bought the close at 29, taking a chance we were going to get an upside breakout. Disappointed with 30, and they'll probably use any bounce to exit. In other words, if you bought the close at 29, disappointed on 30, a lot of traders will try and sell at the 29 close. 31, bear bar closing on its low, probably minor reversal down, but we could easily test down to the 25 close. At the moment, I think the odds are we're going to have to get back down here, even if we go sideways for several bars first. Bull bar, On it closing on its high, 32. We may break to the upside, but if we do, I suspect still minor reversal. 33, follow through bar, barely closing above the moving average, and it's a weak bar, increases the odds of sellers scaling in higher. 34, doji, and then you can see we went sideways, two up, testing yesterday's high. 37, 38, still getting bull bars. On the 15-minute chart, it's a strong breakout. So here's the 15-minute chart. Fifteen-minute chart, you can see strong rally, and that will lower the probability of this going straight down. 39, bear bar, probably buyers below scaling in lower. And then 40, we have a bull bar. But still, again, probably going to start going sideways soon. Doji, 41, more sideways. And then we still ended up going sideways here. 44, we tried to get the downside breakout, but we failed to close on its low. But it's enough of a surprise we may get a small second leg down. It's a bad stop entry buy above 44. That will reduce the number of traders buying above it. And then 45, bear bar, but it closed at the low of 44 instead of below it. 44 low, 73 even, close is 75, 73 even. And then we got a doji on 76. This looks like a leg in a trading range and not the start of a strong bear breakout. But now we have 4 consecutive bear bars, and if we start to get strong bear bars closing on their lows, you'll have bulls who are scaling in lower trapped and they'll look to exit. Bull bar 47 looks like we're going to bounce, and then 48 bull bar testing the highs. What about buying 48? 48 is basically a high one buy. It's hard to see, but you can see it right here. We rallied, pulled back, and we have a bull bar closing on its high, and that's at 12:30 Central Time. And you can see 48 is 12:30 Central Time as well. And then look what happened on 49. Everybody sold it. Bears, enough of a surprise, probably at least a small second leg down, but you're selling low in a trading range, therefore not really ideal. Plus a tail on 49 and bad signal bar 48. Bear, it's a bull bar closing on its high. Not really where bears probably want to be selling. It's also bad risk reward. If you sell here and your stop, where do you put your stop? If you put your stop 1 times your risk, if you put your stop above 43, is down here. So it's basically you have 1 times your risk. In other words, you have one risk reward, a risk reward of 1, and your probability is really close to 50-50. And because of that, I suspect a lot of traders do not want to sell here. Bull bar 50, but after 49, that will reduce the number of traders buying above it. You also have bulls who bought the close of 48, disappointed 49, and they may look to sell on any bounce. 51, bear bar, some of the bears who sold the close of 49 and sold more above 50, they will use any pullback to buy back shorts. And then 52, second leg up after 50, clearly in a triangle. The dangerous thing here is we have 2 targets, the 18 high and the 25 low, and we're right in the middle. So we could break out and reverse, or we could break to the downside and reverse up. 53, bull, doji bar, probably going to go sideways. 54, another doji, breakout mode. And then we had a surprise on 55. It's a breakout below a triangle, but it'd be better to see what the next couple of bars look like. And then 56, we have a bull bar closing on its high. What about buying the close at 56? Some traders might. But if you're buying above 56, it's pretty dangerous. It's the same thing as selling low in this tight trading range. It's really easy when you're in a tight trading range to buy high, sell low repeatedly, and you just get chewed up. And by the time you actually get the breakout, you will not make enough to overcome this loss. 57, bad follow through. So the bulls who bought the close at 56 or above it, probably looking to get out break even. And that's what happened on 58. 58, bear bar closing on its low. Some traders might sell. I think the probability, at least I thought during the time, I thought the probability slightly favored the Bears. I thought the Bulls had a chance here and they couldn't do anything. And then by the time we got to here, it's two legs down, but on a higher time frame, here's the two legs. So this is 11 o'clock, and 11 o'clock is right here. So here's the 60-minute chart. This is 11 o'clock on the 60-minute chart right here. What do you think's more likely? Do you think we're going to reverse all the way up here, or do you think there's sellers above? If I go to a 120-minute chart, it's a big bear bar, so probably a second leg down, likely. But low probability. The market would not be doing this if the probability strongly favored one side versus the other. 59, bear inside bar. I thought it was an okay swing sell and stop maybe above 59 or 57, taking a chance we test the low close of the day. Decent entry bar, 60, but still at the bottom of the range. Probably better to wait for follow through. 61, 4 consecutive barrel bars, 5-bar micro channel. Probably sell the close 61, but a little bit aggressive. And then you can see 62, big bear bar. What about selling 62? I would not. It's a big bar in a trading range, and big bars usually lead to climactic behavior. In other words, profit taking. And look where it's at. It's closing just above important resistance, just above important support. The low close of 25, the low close of the day. So bear bar, we're closing right above it instead of closing far below it. And when you watch this bar, if you watched it real time, you'll see that this bar sold off, had a deep pullback, and that's a reminder that something is not right here. 63, doji, testing the close of this bar, 64 even. 63, the low of the bar, 64 and a quarter. And therefore, traders are not eager to sell down here, and that's a warning that we may just go mostly sideways. Bull bar, 64, but probably sellers above scaling and higher. We may have to test the breakout point all the way up here. But because of the sell-off from the 62 low to the 67 high, probably minor reversal and second leg down. 65 inside bar, probably buyers below, and then 66 bull bar closing on its high. What about buying above 66? It's not really ideal. 3 consecutive bull bars, probably going to get at least a small second leg up. However, it already has. However, the issue with 66 is we rallied on 63, pulled back, rallied on 64, pulled back, rallied on 66, and if we pull back on 67, that could be a variant of a wedge. And then 67, it's a doji, it's a bear bar, probably buyers below, but a lot of the bulls who bought the 66 close are going to be disappointed. And the problem with buying up here is risk reward. So here's the 63 low, here's the 66 close. And you can see if you're buying the close of 66, look at 1 times your risk. It's all the way up around 45.72. And that is really not ideal of an area to be buying. And because of that, a lot of traders are going to be more interested in looking to buy a pullback. Doji 68, buyers below, but it's a bad high 1, and that will increase the probability of sellers above scaling and higher. And then 69, bear breakout, a little bit of a surprise, testing the lows. 69 is a strong enough bar that we may get a small second leg down, but it's not clearly sell to close. And then 70, breaking below a lot of bars to the left, we'll get a small second leg down. And then we sold off into the close. I say that, it's still 72. We sold off for about 4 or 5 bars. Big bull bar, 70, 75. At that point, if I was a bear and I was holding on to shorts, I would get out a couple of points at a minimum above any bar, or better yet, at a maximum. So for me, I think it makes a lot of sense for traders to exit above 75, certainly on 76. And then we got a couple of legs sideways to up into the close. For limit orders, for stop entries, I thought it was okay to buy above 1, but if you do, I would certainly get out a couple of ticks below 6 or as 7 starts to turn down, especially with it testing the September 1st high. I thought it was reasonable to sell below 7. You can sell below any of these bars. What about selling 13? I would not. Probably buyers below. I think it's okay to exit above 15, but if you do, you have to sell again below 18. Betting on a second leg down, you can sell below 20, 21, even sell below 24. But I think 24 is awfully late in the move. Plus 2 legs down. So if you're selling below 24, I'd get out above 26. Probably minor reversal up. Some bulls will buy above 26. Other bulls might wait and buy somewhere around here. But this is so high in the range that the upside is probably limited. And then a lot of bulls, if they bought above 36 and the market started to go sideways, they'd be pretty quick to exit through here. And then what about selling below 45? I would not. And then what's the next trade? It's really not easy. A bull who bought above 50, hoping for an upside breakout, would probably get out around break even a few bars later and maybe selling below 58, 59. But if you sold below 58 and 59, you probably bought above this bar. Maybe you bought here. So you have to be really quick to manage these trades and not take too big of losses trying to catch the breakout of the triangle. 60, bear bar, you can probably sell below that. Some traders will sell below that or sell the close. And as far as other stop entries, maybe selling below 69, that's pretty tough. And then selling below 71 is not that great. The risk is pretty far, and the odds are we're going to test the 25 low of today. And then as far as buying above 75, I think it's fairly late in the day. So probably not worth it. For limit orders, probably buyers below 3, probably sellers above 12, probably buyers below 13. I thought sellers above 17, and you can see there were so many traders trying to sell above 17. There were so many traders selling above 17 that a lot of traders just sold the market on, excuse me, there were so many traders trying to sell above 19 right here that a lot of traders just hit sell the market on the open of 20. And that's why we went straight down. I thought buyers below 28, buyers below 30, and maybe sellers above somewhere in here. But I really don't like to sell this tight of a channel. And then I thought buyers below 44, buyers below 45. And then at this point, I thought triangle. So breakout mode, better to wait for the breakout. And at here, maybe sell the close. As far as selling this close, I would not. I thought sellers above 63, but we could pull back all the way to 45.70 and test the gap first. So if I sold 63 and 64 went up and went sideways, I'd probably just get out around break even. And that's probably it for limit orders, really. Maybe buyers below 77, but awfully late in the day. Buy the close, sell the close. Probably sell the close 7, sell the close 8. You can sell 9, 10, or even 11 if you're willing to scale in. Probably sell the close 20, 21, 22, 23. But with the tails 22, 23, the downside's probably limited. Probably buy the close. Maybe 28, 29, but 29 outside up bar. Instead of buying the 29 close, it's better to look to buy a pullback, which was 30 and 31, and then probably buy the close 33, 34, 35, even 36, but high in the range. And chances are we're going to go mostly sideways. And then through here, it's opposites. Big bear bar, probably buying the close for a scalp. Big bull bar, traders selling for a scalp. Bear bar, traders buying for a scalp. And then this became breakout mode. Maybe sell the close 61, but really tough to do. And the downside is probably limited. And then as far as selling the 62 close, if 63 is your follow through, I think a lot of traders get out near break even. So the close of 62 is 65 and a quarter, and the low of this bar, 65 and a quarter. When you get big trend bars like 62, it increases the risk that the market's going to go more sideways rather than straight down. So big bars, big climatic bars like 62 actually lower the probability and lower the probability of immediate follow through and increase the probability of sideways trading. Let me take a look at some questions. Okay. Question: how do you manage the trade if you sold below bar 49 today? I'm not sure if you sold below it on 61. I'm going to assume first you sold below 61 on 49. That's a reasonable trade. And I ended up selling the close of 61. Man, my thought was I sold, I don't know where it was. I sold below 60, taking a chance the breakout started, but 61 went down and started to pull back, and I was disappointed. And my concern was a possible failed breakout of the triangle. So I ended up getting out near break even for a tick or two profit. And then when 61 closed on its low, I hit sell the market, taking a chance we would sell off quickly on the open of 62. But as far as selling below 49, here, I think it's okay. If you're selling below it, then you don't know if 61 is going to reverse up intra bar. But what you're hoping for is a bear bar closing on its low, and then obviously not a deep pullback. So in other words, what you're hoping for is the bull. You want the bulls who bought the 49 low during 61, which you're taking the opposite trade. But you want the bulls who bought below 49 during 61 to get trapped and panic out of the trade. You can see the low of 49, 70 and a half, and the high of this bar, 62, 70, 75. So a lot of traders panicked when they saw 61 and started selling quickly to exit the trade. Give me just a moment. Question: bar 63 to 67 is a two or three legged move. So 63 to 67. Yeah, you can call it two legs up, three legs up. It's a micro channel, but it's implied two or three legged pullback on a smaller time frame. Okay, back to the question. 63 to 67 is two or three legged move on a lower time frame over which results in reversals of lower time frames. Is this the idea behind implied pullbacks? Yeah, it's exactly the idea. So when you look at a chart, you have to remember that this right here on a 5-minute chart, let me actually show it like this. Here we go. So here is a strong breakout. Now, take a look at these bars. When you look at these bars going down, what you quickly notice is on the right, here's the 1-minute chart. So this is kind of like cracking the bar open and looking how it formed. This is a very strong breakout with no pullbacks. The problem with implied pullbacks is this. So this is 1400 to 1405. Let's go to a 1-minute chart. It's going to be right here. Does this look like the start of a strong rally? Or do you look at this and say, yeah, it's a wedge? Here's a fairly contained sell-off. Here's a pullback. If we go to a 2-minute chart, here's a 2-minute chart. Are you really excited? When you see this, you know that's tight. Are you excited to buy this? No. It can't even break above the moving average. If we go to a 10-minute chart, we sold off. And you look at this and you say, well, yeah, but that's just two bull bars. How in the world? There should be buyers below in a second leg up. Yes and no. Look what happened. Look how these bars formed. We rallied and pulled back to here. Then we rallied again and pulled back here. And then we rallied again. So it's basically like a truncated wedge. 1, 2, 3, or maybe the wedge is 1, 2, and here is the third leg. So that's kind of the way I view implied pullbacks. But yeah, I totally agree with what you're saying. Okay, I'm going to answer one more question. And then unfortunately, I've got to make today's video a little bit shorter. Someone asked about the FOMC. The next FOMC is in 13 days. So it's basically in 2 weeks from now. But back to the question. If the FOMC bar is a small one, should we treat it as like a new day? Whenever I'm trading the FOMC, I always treat the open as a new day or new session. And the reason for that is low probability events tend to happen. So whenever you have the start of an FOMC session, I always treat it as a new day. All right, that's all the time I have for today. But as far as the next couple of days go, we have a bear bar closing on its low. The bears will see this bar is strong enough for a second leg down. So some traders might sell below it, but the channel's tight. Other traders may sell a 50% pullback, hoping for a second leg down. The bears are hopeful this is a wedge. 1, 2, 3. Someone asked if this is a wedge on a daily chart, and it is. There's the wedge. But it's minor. Why is it a minor wedge or you can call it a parabolic wedge? Because of this. Here's the weekly chart. And on the weekly chart, we have a strong breakout. So the best, I think the bulls, the bears, let me back up. The best the bears can probably get is a minor reversal and sideways. So even if we sell off all the way down to 4,500, 4,450, I think the odds are we'll rally up to the July high at some point. Okay, thanks everybody for watching, and I will talk to everybody soon.